right? So you're busy, right? Like you want to learn, but who has time to wade through tons of information? We get it. That's why we're here. On the deep dive, we do the heavy lifting. We take those articles, books, you name it, and we give you the good stuff, those aha moments, but without the headache.
Right. Straight to the point.
And today, well, you guys sent us this book, The Tao of Capital, Austrian Investing in a Distorted World. Quite a mouthful. We're going deep on that today.
Yeah, and this isn't your typical economics book, dry and boring. Forget that. This book, it brings in ideas from economics, sure, but also military strategy, even Eastern philosophy, all to give you this kind of a new way of thinking about investing and even just like understanding how the world works.
Right. We want to make this as painless as possible for you. Your mission today, if you choose to accept it, and we hope you do, is to really just absorb the key takeaways from this book. We're going to walk you through the fundamentals of Austrian economics, but more importantly, what it all means in practical terms. So get ready for some unexpected connections, because this book has a lot of those surprising perspectives.
Yeah, and this isn't some fringe stuff either. The Tao of Capital has gotten attention from some pretty big names in finance. Like, you've got Victor Niederhofer, Byron Wien, David Stockman, Peter Klein. These guys, their endorsements are right there in the intro of the book, Shows you the kind of credibility and the wide-ranging thought you're about to dive into.
All right, so let's get into it. The book starts off by laying out the foundation, the core principles of this Austrian school of economics. This isn't like brand new, right? It has some deep roots.
Right, yeah. And it goes back to classical liberalism, like way back 18th and 19th centuries. The big focus here is on individual rights and the idea of a self-regulating society where people are pretty much free to do their thing as long as they're respecting each other's rights, of course. There's this quote from economist Ralph Raico that I think sums it up really well. He describes liberalism as like a society based on this voluntary cooperation where individuals have a lot of leeway to operate within, their own sphere of rights.
And when we talk about those individual rights, what are the ones that really stand out from the Austrian perspective?
Well, private property is huge, right? Like owning things, and then freedom of contract, being able to make agreements freely. These are like the bedrock of a healthy economy, according to the Austrian school. And it's interesting, mainstream economics kind of takes these things for granted sometimes, but the Austrian school really emphasizes their importance, especially when you start looking at places where those rights are shaky.
Okay, so let's talk money. The book talks about the Austrian view of money and where it comes from. It's a little different from the usual story, right?
Yeah. This is one of those key points where the Austrians really diverge. So, guys like Mises, they argue that money actually emerges naturally in the market as people start using a specific commodity for trade. This is different from the idea that governments just, decide what money is. Mises pointed out that money plays these three super important roles. It's a medium of exchange, so you can trade stuff. It's a unit of account, so you can measure value. And it's a store of value, so you can save your wealth. And the Austrians argue that when governments mess with money, it can create some pretty serious unintended consequences down the line.
It's interesting that the book mentions a growing interest in Austrian economics, especially among young people. Why do you think that is?
Well, the author points out that ever since the 2008 financial crisis, there's been this surge in interest in Austrian economics, and especially among younger folks. He sees it as a good sign, like a growing skepticism towards government intervention in the economy, and a renewed interest in those principles of economic freedom, individual freedom.
Right, so we've got the basic framework of Austrian thought. Now, the book introduces this super interesting concept. It calls it the roundabout approach. Sounds like it's a core strategy, almost like a whole philosophy, right?
Yeah, exactly. Roundabout is central to the book, and what's fascinating is how the author connects these seemingly unrelated ideas to explain it. He talks about his early experiences, learning the ropes from this grain trader at the Chicago Board of Trade, Everett Klipp. And the thing is, Klipp's lessons, they had this echo of ancient wisdom, like from Taoism, specifically the Laozi, also known as the Tao Jining. Pretty wild, Rob.
Taoism and Chicago grain trading. That's a combo I wouldn't have thought of. What's the connection?
Well, the idea is that sometimes the most effective way to reach a goal isn't the most direct route, It's about being strategic, taking a longer path, maybe a less obvious one. The book uses this great analogy of a conifer tree versus a faster-growing flowering plant, an angiosperm. The conifer, it puts its energy into building deep roots, thick bark, its core assets, even if it grows slower at first. But this roundabout investment, it makes the conifer super resilient. And in the long run, it can outlive and outcompete those faster growing plants. There's even a chart in the book, figure 2.1, that shows this difference in growth. So the takeaway for investors might be that sometimes it's better to focus on building a strong, resilient portfolio, even if you're not seeing those quick gains right away.
So it's about building that solid foundation, even if it takes a bit more patience. Makes sense. But the roundabout idea isn't just about trees, right? The book connects it to military thinking, too.
Right. The author sees these strong parallels in military strategy. He brings up Sun Tzu, this ancient Chinese general and strategist, and his concept of shi. Shi is all about gaining a strategic advantage indirectly, often before any actual fighting even starts. It's about positioning yourself for victory by setting the stage carefully, rather than just going in for the kill. There's even this quote from Sun Tzu. It says, "To win 100 victories in 100 battles is not the highest excellence. The highest excellence is to subdue the enemy's army without fighting at all." Powerful stuff.
Yeah, that's thinking ahead. Achieving goals through smart positioning, not just brute force. And the book also brings in Clausewitz, right? The Prussian military theorist.
Exactly. Clausewitz, in his book On War, he also emphasizes this idea of roundabout strategy, although it's often misunderstood. He talks about this framework of Ziel, Mittel und Zweck, aim, means, and end. The idea is that those lower-level guys carrying out the operations, they focus on the intermediate objectives, the Ziel as a means, the middle, for the overall strategist to achieve the ultimate goal, the Zweck, which is victory and lasting peace. It's about taking this less direct route in the short term to get a more decisive outcome later on.
So whether it's the slow growth of a conifer, the maneuvering in war, or the long-term perspective in economics, it's all about that delayed gratification, taking the indirect path for greater effectiveness. And this roundabout thinking, it connects to other economic ideas as well.
Oh, absolutely. The book links it to Frédéric Bastiat, this French economist from the 19th century, considered a forerunner to the Austrian school. Bastiat really stressed looking at not just the immediate consequences of economic actions, what you see, but also the unseen consequences. And to grasp those longer-term effects, you need that roundabout or intertemporal perspective. The book also talks about Karl Menger, the founder of the Austrian school, who took this a priori approach to economics, meaning reasoning from first principles, as opposed to the more data-driven approach of the German historical school. Menger's focus on those fundamental principles was itself a kind of roundabout way of understanding things.
So it's not just about the numbers, it's about understanding the why behind them. And this leads us to the market as a process, right?
Yeah.
And this concept of homeostasis, this sounds like it's about how markets react to disruptions, how they try to find balance.
Exactly. The book really emphasizes Ludwig von Mises' focus on acting man, this idea that individuals have goals and they act purposefully. Mises argued that this subjective nature of human goals, it's crucial to understanding how the market really works. He believed that you have to understand economic principles first before just diving into data to avoid misinterpreting things.
So it's about understanding the motivations, not just the numbers. How does this relate to the market as a process?
Well, the book uses this vivid image of a trading pit, that chaotic environment of buyers and sellers constantly interacting. That's a prime example of this ongoing process of price discovery. As people react to new info, they adjust their offers, and errors get corrected, leading to these temporary points of balance or states of rest. It's constantly moving, evolving.
And this leads to the idea of market homeostasis, this self-regulating thing.
Yes, exactly. Homeostasis in the market refers to its inherent ability to bounce back, to return to a state of balance after some kind of shock or disruption. It's a self-correcting mechanism. The book even mentions Kant's idea of a teleomechanism, this system that seems to have a purpose, in this case equilibrium, but it achieves it through purely mechanical processes.
Can you give us an example of how this homeostasis thing actually plays out in the market?
Sure, a classic example would be those boom and bust cycles. A boom, you can think of it as a period of overinvestment in certain areas, often driven by, easy credit. We'll talk about that more later. This throws the market off balance. Then the bust comes along, and that's the market's way of correcting those excesses, bringing things back in line. It can be painful, sure, but it's seen as this necessary rebalancing. The book also highlights Hayek's concept of mutual adjustments, how individuals constantly adapt to each other's actions in the market. And there's this related idea that sometimes the best thing policymakers can do is just stay out of the way. Like, don't just do something, sit there.
That's a perspective you don't hear very often. Now, the book delves into this concept called time preference. What is that exactly, and why does it matter in this context?
Okay, so time preference is this fundamental human tendency. We generally value something we get sooner more than the same thing we get later. We all tend to favor the present over the future to some extent.
So it's like wanting that small reward now instead of waiting for a bigger one later, right?
Exactly. And Böhm-Bawerk, another big name in the Austrian school, he observed that this preference for the present is not only subjective, but it can be inconsistent. He talked about time inconsistency, where our choices about immediate and future rewards can change over time. We might plan to be patient tomorrow, but then tomorrow comes and we still go for that instant gratification.
And how does this time preference thing tie into the economics we're talking about?
So the book explains that artificially low interest rates, often a result of, increasing the supply of credit, can distort our natural time preferences. Low rates make it seem cheaper to borrow and invest, so businesses might take on these longer-term, more roundabout projects. But if those low rates don't really reflect people's actual desire to save and invest, the whole economic structure can become unsustainable, leading to those boom and bust cycles Mises talked about. Basically, low interest rates plus our tendency towards this thing called hyperbolic discounting, meaning a really strong preference for immediate rewards, can push investors towards those quick returns instead of the slower, patient work of building long-term capital.
The book uses some pretty interesting examples to illustrate time preference, right?
Yeah, it talks about the marshmallow test, where kids get to choose one marshmallow now or two if they wait. It's a great way to show the challenges of delaying gratification, of self-control. And it's interesting, the book points out that how much the kids trusted the experimenter, like whether they actually believed they'd get the second marshmallow, played a role in their choice. It also uses classic stories like Aesop's fable, the ant and the grasshopper, and the three little pigs, those cultural examples of short-term versus long-term thinking. And for a more roundabout example of patience, it even mentions the children's book, The Carrot Seed, how consistent effort over time can lead to a big reward. And finally, it touches on the Protestant work ethic, this cultural influence that encouraged a lower time preference because of its emphasis on hard work, saving, planning for the future.
So our impatience, how it interacts with things like interest rates, it can have big consequences for the whole economy. Now, the book gets into Austrian business cycle theory, or ABCT, and introduces this concept called the Misesian Stationarity Index. Sounds kind of technical.
Yeah, let's break it down. Austrian business cycle theory, it was developed by Mises, and it tries to explain why economies go through these booms and busts. The core idea is that these cycles are mainly caused by banks creating too much credit, expanding the money supply artificially. This pushes interest rates down to artificially low levels, and then businesses start making these investments that look profitable because of the low rates, but they're not really sustainable in the long run. It's important to understand that when Austrians talk about inflation here, they're mainly talking about this artificial increase in credit, not just rising prices. While credit inflation can lead to price inflation, the key issue for ABCT is that it distorts the economy's capital structure.
And where does the Mises Stationarity Index, the MS Index, fit into all of this?
So the MS index is presented as a way to measure how far the economy has strayed from this theoretical state of stationarity, basically a balanced state of economic activity. And it does this by looking at how much monetary distortion there is. It's a ratio comparing the price of existing businesses, think stock market values, to the cost of actually replacing those businesses, their true fundamental value. The idea is when the MS index is high, it means the price of those assets is inflated, relative to their underlying value, often because of all that easy credit. And according to the theory, this is usually followed by lower returns in the stock market down the line. Conversely, a low MS index might suggest that assets are undervalued, and that could lead to higher returns in the future. There's this figure 9.2 in the book that shows this inverse relationship, high index, lower returns, and vice versa. Think of it like an old house in a hot market selling for way more than it would cost to build a new one. That might be a sign of an overheated market.
That's an interesting way to think about it, like spotting bubbles or undervalued markets. But does this MS Index tell us anything about how much businesses will actually invest in the future?
Well, the book points out that there's no strong statistical link between the MS index and the amount of real investment businesses make in new capital goods. So even though monetary policy might pump up asset prices, it doesn't necessarily translate into real productive investment in the economy. And figure 9.3 in the book shows that higher MS indices are actually linked to bigger potential drops in the stock market. The author does mention a basic trading strategy based on these high and low MS index readings. how it's performed historically, but he does acknowledge that some of that is looking back at past data.
So the MS index might give us some clues about valuations, but it's not necessarily a crystal ball for overall economic growth. Now, the book introduces the Siegfried firms. Sounds like something out of a legend.
Yeah, it's a memorable term the author uses to describe companies that have this high return on invested capital, or ROIC. ROIC basically tells you how effectively a company uses its invested capital to generate profits. So, Siegfried firms, they're the champions of capital allocation. They're really good at reinvesting to create value.
And how do you spot these Siegfrieds? Is it just about looking for companies with high ROIC?
Not quite. The book introduces this thing called the Faustman ratio, which is basically the company's market capitalization, its total stock market value divided by its net worth, its assets minus liabilities. The author suggests looking for companies that have a low Faustman ratio combined with a high ROIC. That low Faustman ratio could mean the market is undervaluing the company, and when you add that to a high ROIC, you might have a really attractive investment, a Siegfried. He emphasizes that you need both. You can't just look at one or the other.
So it's about finding those hidden gems, the companies that are both efficient and potentially undervalued by the market. Finally, the book talks about sisu. Now, that's a Finnish word, right?
Yeah, sisu is Finnish, and it's a concept that doesn't really have a perfect English equivalent. It's this idea of gritty perseverance, this unwavering determination, exceptional willpower, like the mental toughness to stick with something difficult for the long haul.
And why is this sisu thing so important in the context of Austrian investing and this roundabout approach we've been talking about?
Well, because that roundabout path, it often involves delays, obstacles, times when the payoff isn't clear. You need a lot of endurance, a strong commitment to the goal, the zweck, and the strategic advantage, the shit you're aiming for. The book connects the idea of making nets and boats, those more indirect, capital-intensive methods of production, with the progress of society and the expansion of freedom, referencing Mises' view of capitalism. It even tells this powerful story about Mises' book, Human Action, falling onto a piece of the Berlin Wall, symbolizing the triumph of those ideas of capitalism and freedom after a long struggle. Sisu is presented as that crucial ingredient for navigating that kind of journey.
So to bring it all together, this deep dive into the Tao of capital has taken us through the core principles of Austrian economics. The strategic wisdom of the roundabout approach, the market's self-correcting nature, the role of our natural time preference, how monetary policy can distort it, a potential tool for assessing markets with the Misesian Stationarity Index, a way to identify those potentially undervalued, high-performing Siegfried companies, and the importance of that gritty perseverance, Sisu.
Exactly. We've covered a lot of ground, some really thought-provoking stuff, hopefully in a way that gave you some insights and things to consider without being too overwhelming.
And that brings us to our final thought for you today. Think about how much emphasis our world puts on the short term, whether it's the ups and downs of financial markets or just the daily demands of life. How does that tension between the short-term pressures and the long-term vision, the vision needed for real capital creation, and we're talking about more than just money here, but also knowledge, relationships, progress. How does that play out in your life and the world around you? It's something worth pondering, even after this deep dive is over. Thanks for joining us.